Thank you and good morning. Very warm welcome from myself. My name is Jacek Pastuszka and I have the pleasure for the last 6 months to be the CEO of Anora. My objective for today, and I have around 20 minutes, is to give you a brief update on or information on what Anora is all about, tell you a few words about our sales, our profits and our cash position, and then provide a bit of outlook for 2024. But before we get there, let me start with the most important thing, which is the team, the management team that I have a pleasure of heading. The team is all here, so I would ask you, when I mention your name, to stand up, raise your hand, and wave to the audience, because they are all, the management team is all available after this meeting for potential questions that you might have. So let me start with our CFO, Sigmund Toth. Sigmund has been with the company for many years. Regretfully, he is leaving us in August, and in August, in an orderly transition, he will be replaced by Stein Eriksen, currently the CFO of XXL Sports Retailer. Then the second person I would mention is Janne Haltunen, who is in charge of the wine business. Then we have Kirsi Puntila, who is in charge of our spirits business. Risto Gagel, the head of supply chain and industrial. Mikael Pilemant, the chief growth officer in charge of business development and M&A activity as well. And then last but definitely not least, Johanna Sunden, the most recent addition to our management team, who is in charge of HR. Now to what Anora is all about, in brief. Anora, as most of you probably know very well by now, is a wine and spirits powerhouse, a brand house, holding a very strong position in the Nordic markets. We are a pan-Nordic wine and spirits operator, which reinforced this position significantly after the merger. We are number one in spirits in 3 out of 4 markets. The only exception is being number 2 in spirits in Denmark. And in wine, which is a much more fragmented business, we are number 1 in Finland, in Norway, and in Denmark. We are number 3 in Sweden. We also have a smaller position in Germany and in Baltics. But the most important message for all of us here is that we hold a very strong wine and spirits position at pan-Nordic level. We are also a role model in sustainability. We want to see ourselves as somebody who is doing more on sustainability than the public would expect from us. For us, sustainability is not only a hygiene factor. For us, sustainability is a business imperative, and is also a differentiator versus our competitors. So sustainability, also as measured by our position in various rankings, is the key priority for Anora. We have a very strong and versatile portfolio of businesses or brands. It's a unique portfolio mix of own brands, both on the spirits and the wine side, and strong partner brands, again, both on the spirits and the wine side. Look at this, or think of this as a table with 4 strong legs. These businesses have some differences between themselves. These buckets of businesses, they have some specificity, and there are differences in marginality and size, but each of these buckets is extremely important for us, and we are maximizing or aiming to maximize our performance in all 4 of them. When we talk about our performance in 23, you will see that the one leg of this table was much shorter. One part of this business was performing much worse, which was the partner wine brands, especially in Sweden and Norway, and I will talk about details in my further presentation. The chairman has already mentioned some of the key numbers of our business, so I will very briefly just repeat them. We have a revenue growth of 3.5% in 23, coming entirely from the acquisition of the Globus wine business in Denmark. And we had a comparable EBITDA decline of 10% in the same year, down to 68.2. Admittedly, this was the lowest EBITDA in the last 5 years. So, as also it was stated before, it was a challenging year for us. It was a difficult year with quite a lot of headwinds. I think we have managed to get the most out of it, but it's important to remember what this perfect storm was all about and what the 4 headwinds that we are facing were about. First, what we saw was harmonization of the trade channels after COVID. In simple language, it means that the business gradually moved from more profitable channels to less profitable channels of distribution. Also, we have seen inflationary pressure, mostly due to macroeconomic and political situation, which increased raw material prices. The third important element for us, given the mix of businesses that we have, was the devaluation of the key 2 currencies at the Nordic level, which is the Swedish and the Norwegian crowns. And this devaluation had impact on many levels, but it first and foremost reduced our net revenue in consolidated results, and it also dented our profits. And last but definitely not least, we have seen the results, the lost revenue, the lost sales from the termination of 2 large wine partner contracts in Sweden. The combination of these 2 factors led to the decrease in profitability by 10%. However, the management has taken action from the beginning of the year when this started being visible. The action that was taken by the management was mostly around price increases, around cost cuts, about changes in the operating model, and also importantly around continued production network optimization under the Center of Excellence concept project. And the cumulative effect of some of these actions we start increasingly seeing. The chairman has mentioned it as well. In the 4th quarter of the year, we started seeing the positive effects of the actions taken in reaction to this perfect storm I was describing before. There were also some extraordinary items that impacted our bottom line performance related to Larsen divestiture and also impairments to our assets that we have conducted after the impairment testing at the end of the year. I will get to some of these items a little bit more in the course of this presentation, but let me now give you a little bit more perspective on how balanced our revenue, our net sales is between channels, between sectors or segments, between countries, and between own and partner brands. The key message from behind this slide is that Anora is a very well commercially, a very well balanced business, a business that has many legs to stand on, that provides lots of stability and should provide lots of confidence to the shareholders about the future of this business. When you look at net sales by segment, almost half of revenue of net sales comes from wine, 33% from spirits, and industrial is 21% of the business. In terms of the country breakdown, which is another indication of how nicely balanced this overall business is, Sweden 23%, Norway 17%, Finland 15%, Denmark 16%. So as you can see, very well balanced between these 4 markets, and more than 80%, excluding industrial, of our net revenue comes from the Nordics. We are a pan-Nordic operator with a little bit of international presence, but our strengths, our key place of activity is obviously the Nordics. We also have a very balanced portfolio of partner and own brands. I mentioned it also before that we have these 4 legs on which we are standing on. When you look at our net sales breakdown between the own brands and partner brands, it's 52 to 48. I will not go into more detail on net sales in the interest of time. Let me focus on the second big element, which is obviously profit, comparable EBITDA. I have mentioned already before, including the reasons for it, that it decreased by 10%, down to 68.2. And it was, as you can see from this chart, in the last 5 years, this was the worst result on the bottom line front. When you look at the breakdown of where this decline came from, it is the reflection of the comments I made already. The key source, the only source of our profit decline in 2023 was poor performance on a year-on-year basis from the wine business, which I will talk a little bit more in a second. Spirits performed well, adding 2.4 million to our year-on-year results, and industrial was as expected, flat versus previous year. Let me dig deeper into these three segments of our business: wine, spirits, and industrial, providing a bit more depth into our performance in these three segments. Net sales in wine increased by 5.6%, by around 6%, which is entirely the result of the Globus wine business, the wine business that we acquired in Denmark, being accounted for half a year on a comparison basis in 2023. But the real impact of the headwinds that we have faced, the loss of partner contracts, the currency situation, the raw materials, the increased inflationary environment, all of this is reflected mostly in the bottom line. As you can see, the bottom line in 23 from the wine business has halved. So it was down from 23.5 in 22 to 12.4. So in 23, we delivered half of the profit that we have delivered in 22. Also, the marginality of this business decreased significantly to only 3.7% EBITDA over net sales. The good news is that the actions taken by the wine team in reaction to this difficult beginning of the year started bearing fruit in the fourth quarter. So if you had a chance to take a look at our fourth quarter report, and I'm sure you did, you have seen that the performance from wine was as strong as the performance from spirits. So these two key cylinders of the Anora engine were performing well in Q4. But it was not enough to offset what happened, especially in the second and the third quarter of the year. Spirits is a different story. It was a very reliable source of both revenue and profit in 23. As you can see in this chart, the net sales increased by 1.4%, mostly driven by steady but surely developing international sales. And then comparable EBITDA was also very strong, growing to 40.3 million euro. And the marginality of this business, the EBITDA margin of this business, increased to 17%. So it was a very successful year for spirits. And then industrial, as you can see, a decrease of 6% in net revenue. The external net sales, which is the sales of side products from the ethanol production in Koskenkorva mostly, and a bit of contract manufacturing, and the logistic services we provide in Norway. So the external sales decreased by 3%. Importantly to know, the profitability, both in terms of margin and the absolute bottom line, were in line with expectations, and they were flat versus previous year. Maybe an important comment on industrial here is about the role that industrial plays in our business. This is not the part of business where we are actively promoting and driving net revenue. The primary purpose of the industrial part of the business is to improve the efficiency and economics of our supply chain overall. Let me talk about the cash situation. It's clearly a highlight of the year. The actions taken by the management throughout the year, as I mentioned before, also culminated in the strong Q4 performance, and there's no other place where it's visible more than in our cash situation. It's just enough to look at the numbers. Our net cash flow was at 135, significantly above the net cash flow at the same point in time last year. Our net debt was reduced significantly from 300 million euro at the end of last year to 138. And then, as a result of all that, the net debt leverage, so debt versus the comparable EBITDA, was reduced to 2 versus a relatively high level after the acquisition of Globus Wine at 4 last year. So how was it possible? How did we manage to improve our cash position so significantly, which also allowed us to maintain a strong capacity for dividend and to recommend the dividend level that the chairman was mentioning before? So there were 3 primary reasons for this strong cash situation. The first one was Larsen divestment that we talked about before. The second one was sales of receivables or using factoring on the side of receivables. And then the last one was inventory reduction. Part of this inventory reduction was obviously the result of the Larsen divestiture, but part was the steady effort by the team to optimize our stock levels and reduce inventories to improve our cash situation. And we expect this work to continue down the road also this year. So cash position was very strong, and how we finished the year was definitely the highlight of our financial performance on the cash side. Which takes me to the financial targets. These are 2030 financial targets that we have communicated as part of the Capital Market Day presentation in November 22nd. There are 4 of them. We are delivering on 2. We are clearly struggling still at 1, and this one that it requires much more work is the marginality of our business. As you have seen before, it is around 9 or 10% in 23. We are still far away from 16% that we have communicated, and this is the primary focus of the management team to improve this indicator. On other fronts, the net leverage ratio, as I have mentioned before, seems to be moving in the positive direction, and we feel comfortable with our cash position and our ability to engage in M&A activity if the right opportunities present themselves. And then on dividend payout, the result provided here is negative, but it's a bit of technicality linked to our profit, net profit for the year. In the end, I believe the fact that we were able to propose 22 euro cents per share at the same level as last year indicates that we feel confident about our cash position and distributable funds. A few words about the guidance for next year. I have mentioned before that we were dissatisfied with our EBITDA performance in 23. It was the lowest level in the last 5 years. We definitely need to turn it around. We have put in place a guidance which we are very confident in of 75 to 85 million EBITDA, comparable EBITDA for 2024. This would be a 10%, a double-digit increase versus the result of 23. And importantly, if we deliver in the mid-range of this range, in the middle of this range, then the result will be better also than 22. So in 24, we are expecting to have far higher EBITDA performance than both in 23 and in 22. I think these are all prepared comments that I have had on the business. I hope I had a chance to provide not only to present the management team, but also to provide a brief on what Anora is all about, a few words about our sales, about our financial performance, and about our profit and cash. The key point I would like to make is that it is a very well-balanced business, in my view, balanced between categories, own brands and partner brands, channels and countries. So it has all that is needed to improve the financial performance, and the management team is committed to continue doing it in 2024. Thank you very much.